Good evening. You're watching PTV. We're in the 7 o'clock hour, and so it must be on your mind. Amidst all the various things we can discuss this evening, we're looking at valuable things, things that makes for good stock buying, and opportunities available to all. We've been able to come up on a lovely writer who's written about values, including his last book being the $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. Certainly you would want to know that we're talking about a group called Bullion Management Group Incorporated. Bullion Management Group includes the Bullion Management Group Fund, Bullion Management Group Bullion Bars, and the Bullion Management Group Resources. And of course, we're talking about dealing in gold. Now, you've seen the fluctuation of oil over the years, and as we've come to where we are today, we've heard more and more that gold is the safe investment. And so we're going to be speaking to Mr. Nick Barashef. Mr. Nick Barashef, who's written $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. And so welcome to On Your Mind, Nick. It's good to have you, and it's good for you to tell us not only about your book, but how you came to understand that gold is the safe haven. So let's begin right there. How did you come to understand that gold is the investor's safe haven?
Well, first of all, thank you for having me on your show. It's a pleasure. In terms of some of these questions, I really started this particular project in about 1998 when I felt that gold was approaching a bottom, and I was looking for what the next trends would be. And at the time, I concluded it would be precious metals, energy, and water would be the three trends that would do well regardless of the economic conditions. And why, you know, gold somehow, I've been in the investment business all my life, and somehow in the back of my mind I've always considered that everybody should always have 10% in gold. I don't know where that came from, but that's always been there. As I started researching things in '98, then it was like peeling an onion. As you peeled off the layers, the more concerning the story became with respect to the fundamentals of money. And that's really where it starts. You have to understand that gold is not an investment. It's money. Always has been for the last 3,000 years. Still is today. Many people think, well, it's an archaic relic and we don't need, gold anymore. But if you were to look at the central bank balance sheets of all the Western governments, and under assets, you would find monetary assets, and then when you looked at the footnotes in the back under monetary assets, you would see two things: foreign currency reserves and gold. So the central banks, the governments understand that gold is money. Alan Greenspan understands it's money. He's written articles on the subject. And that's really the starting point to understand this.
Having told us about your understanding and why you would be leading in that direction, what then made you to write this book so that you were sharing this information? Oftentimes, we see information and we wonder how real it is. What made you to write this book? And maybe you want to allude to how real it is. That's connecting the first question to now.
Well, that's a good question. And when I started in Canada, we couldn't hold precious metals in terms of physical bullion in our registered retirement savings account. So I thought, well, if I structured an investment offering like a mutual fund that would allow investors to do that, then it would almost sell itself, and so on. That's what surprised me, and there was a great deal of misunderstanding, misconceptions, and some cases almost a hatred of the concept of gold. So as we went along, I wrote more and more articles to help people understand what it is and why they need like at least a 10% allocation. And that's where the book came from. It was going through hundreds of books. We've got hundreds of reports on the subject, and that's where you see, you know, in the book, it's not simply my opinions on everything. There's pages and pages and pages of references to where this came from. So it's not simply Nick Bereshev's opinion. There's dozens and dozens of people that, you know, agree with my point of view.
And of course, Nick, there is the appropriate question. In terms of gold bullion ownership, there are many myths which keep a large portion of the population in fear of such an idea. In your book, you focus on the myth of gold as a risky asset and how it is deemed useless because it doesn't pay dividends or interest. Would you care to expand on this and take your time in so doing so that we are clear in understanding?
Well, sure. In the book, there's a whole chapter covering the different myths, but if we focus on those two, which are you know, fairly predominant myths, like first of all is a risky asset. In the book, I look at, you know, analyzing risk, and there's maybe 15 different risk factors as they apply to any investments, and something like 3 or 4 of them would even be applicable to gold in the first place. So that's a great deal of misconception in terms of analyzing and measuring risk. In that, which gets a bit technically complicated, volatility is a very poor measure of risk, or volatility or standard deviation. And it's a very unsophisticated mechanism to measure risk. More accurate measures are the Sharpe ratio or the Sortino ratio, and they measure risk relative to return, in the case of the Sharpe ratio. And in the case of the Sortino ratio, it measures downside risk relative to return. Nobody cares about upside volatility. If the asset's going up 20% a year, we don't call that a risky asset. So it needs to measure against that. When we compare all the 30 Dow components, which most people agree are not risky, we would find that gold, silver, and platinum has outperformed just about all of them at lower volatility levels. And that chart is in the book. So that's number one in terms of risk. And when you analyze the issue in terms of gold, silver, platinum, they simply are not as risky as most financial assets. The second myth that we get, well, it's really not a myth, but a misunderstanding. Gold doesn't pay interest or dividends. Well, if you take a stack of euros, US dollars, Swiss francs, Canadian dollars, you take your pick, and you put that stack of dollars in the vault, you will not get interest or dividends. Same applies for gold. In order to get interest or dividends, you take your gold or your dollars out of the vault, give them to somebody else, hope they'll return them in the future, and in the meantime, they promise to give you interest or dividends. People that hold gold simply are not prepared to take that risk of not getting their gold back for the minimal interest that they would get on it. So that it simply doesn't apply. You can turn your gold into bonds just like you can turn cash in your savings account into bonds by putting it at risk and then getting dividends and interest. So that one is just a misconception that doesn't apply at all.
So then you also think that gold is safe not only for the investor, but for the small investor, somebody who's thinking that he needs some kind of investment. He wants something to invest in so that he could have a return later on, or that his savings are quote-unquote safe.
Well, that's the general consensus thinking, but again, if we go back to what I was saying. I don't look at gold as an investment at all. I look at gold as money, and if anything, I'm holding the money and not choosing not to invest it, i.e. not put it at risk to get capital gains, dividends, or interest. The issue there, and that's where the understanding between money and an investment comes in. So it doesn't matter whether you're a central bank or a small investor, the same principles apply to all of them. And when it comes to money, money needs to do three things. It needs to be a medium of exchange, a store of value, and a unit of account. Now, the currencies that are throughout the world are good as a medium of exchange. They're good as a unit of account, but they've been completely useless as a store of value. Alan Greenspan wrote a paper in 1968 called Gold and Economic Freedom, and he discusses in depth in that paper the meaning and the attributes of money. So the issue there is that when I hold my money, I want to be able to buy the same amount of stuff tomorrow as I could today. And when the U.S. and the various other nations went off the gold standard, money no longer held its value. And the 1971 dollar, for example, is worth about 10 cents today. That's how much the currency has depreciated. So people were forced to invest because the money didn't hold its purchasing power. If you go back to the previous reserve currency, which was the British pound, it lasted for 300 years, and it did preserve its purchasing power for the entire 300 years because it was fully backed and exchangeable into gold.
How does your understanding of gold and its safety then compare to what we see as the monetary values of today? The U.S. with its dollar, the Canada with its dollar, the Europe with its euro, of course, and in Europe with its euro, you have the United Kingdom with its pound sterling, and so on as the list goes. How is it that gold is safer than these monetary items that we see, these dollar notes, these coins? What makes gold the item of choice?
Well, we have a chart that shows the cost of different items in gold ounces, and that gives you a true measure. So, for example, if you go back for a few decades, you find that you could buy more cars with less ounces of gold, more houses with less ounces of gold, and more equity investments in the Dow with less ounces of gold. And to give you just one specific example in terms of recently, there's a certain amount of euphoria about the Dow going up, and gold has been in a bit of a correction. But when you just go back to the year 2000, it took 44 ounces of gold to buy the Dow. In other words, you take the Dow divided by the price of gold. Today, you would only get less than 9 ounces back. So that's the true measure of what's happening to the currency and all the other investments. So it boils down to that if you just kept your gold and didn't invest it, you would have preserved purchasing power better than if you had invested it in the Dow, in bonds, in real estate, in whatever the case may be.
When we talk about gold in this manner, Nick, are we suggesting then that gold in its finest is this item of choice, or anybody who might say, fine, I have found some gold somewhere on my property, or maybe I have a quantity of gold dust that can become compounded to make for future investment? How wide a frame are we looking at? Is it just a finished product? Is it the dust that we find? Speak to us in that regard.
Well, we don't deal with, either mine supply or individual supply, and there are many countries where you can find gold nuggets on your property. But there's a extensive process to refine it in terms of purity and so on. So to be saleable in the retail marketplace, it has to conform to various standards. In terms of gold bullion, those standards are set by the London Bullion Market Association in London, and they set all the requirements right from the mine through transportation, through the vaults that it can be held in, and provides all the specifications and purity for the bars. So it's if you're lucky enough to find gold nuggets on your property, that's great, but there's a big process to go through, before it's saleable as a finished product.
How would you compare the current bull market to the last bull market with relation to gold's legacy and its performance? And I want to take that even further. We've watched gold come way down, certainly not too long ago, and I'm sure I'm talking about the early 80s here. And then we've watched gold take its time and steadily increase. Compare those for us.
In the 1970s, the rise in the gold price was largely restricted to a decline in the US dollar, and to a lesser extent the Canadian dollar and the British pound. It wasn't a global phenomenon like we have today. And that was due to the fact that in August 1971, President Nixon removed the gold backing, and US dollars could no longer be exchanged for gold. It was essentially a default by the US government. So the gold price rose in US dollars throughout the 70s. It didn't rise in, for example, German marks or Swiss francs. And the main buyers today, China, India, and Russia, were not involved in purchasing gold in the 70s. So there's a big difference in terms of what's happening. The second issue is that the buyers that we have now, like for example, of all the bullion sold in 2012, North America only accounted for 2.5% of the total. So that's North America. As you can appreciate, Canada is probably less than a rounding error. So all the bullion is being bought in the East, in the Middle East, in Southeast Asia, China, etc. So it's a different phenomenon. The second thing is, even in that bull market, gold went from $35 an ounce to $200 an ounce by 1975, then had a correction very similar to right now, where it dropped to $100 an ounce in '76, and then went from $100 an ounce in 1976 to $850 an ounce in 1981. The reason that the rise in gold price stopped is because Paul Volcker, the then Fed chairman, kept rising interest rates until the interest rates became positive in real terms. Up until that point in time, interest rates were rising, but inflation was rising faster. So interest rates were negative through most of the 70s, as they are today. But when Volcker hit 18%, interest rates surpassed what was then 12% inflation, and it became more profitable to then invest in interest-bearing instruments than in gold. And that's what caused the decline in the gold price in the 1980s. My book also deals with an entire chapter as why the gold price stayed down throughout the 1980s until the end of about 1998, when it started rising, when the Washington Agreement was signed, limiting how much gold the central banks would sell. When
you look at gold, It seemed to be since the 1980s that we just talked about that the media has placed a stigma on gold as being a bad investment. Right, wrong, how do you look at it? And maybe you can talk to us as to why the media would see gold as bad investment. Is there another myth that we ought to know about?
Well, it's not just the media, but it's also the economics professions, the central banks. When the price of gold rises, it's essentially a non-confidence vote in the monetary management of the country's currencies. So, as it rises, that's saying that the central banks and the government isn't doing a good job. So there's a vested interest to downplay gold. And we hear all kinds of comments about it being a bad investment and this and that and the other thing, but when you analyze it, it's simply not true. And that's what I tried to do in the book, is to bring out the facts of the matter, and then people can make out their own decisions as whether what they've been led to believe is actually valid.
In writing your book, certainly this is an endeavor to, as you see it, make available this area of investment to others who might not know as much about it. Is it merely a market scheme? Is it the best investment that one could make? Must we invest through your companies, or is this just the better way to go?
Well, first of all, yeah, the way you've worded the question is as if this is the only investment people would have. The starting point is that gold is a great diversifier for a portfolio. So I tell people, begin with 10% of your portfolio and buy gold with that. And then take the time to educate yourself and see how much more than 10% you're comfortable with. Having been in the business for the last 14 years and read dozens and dozens of books and researched the subject to death, I'm comfortable at 100%. But that's not for everyone. Many people won't sleep nights if they were to do the same thing. So it's not worth losing sleep over. But you have to educate yourself and become fully familiar with gold, its attributes, what the outlook is, and then you can sleep at nights and be comfortable with your decision, whether it's 20%, 50%, or 100%. When it comes to buying gold, the critical part is there's a huge difference between owning gold and investing in a tracking vehicle. So a tracking vehicle is a proxy or a derivative that simply tracks the price of gold, but you don't own any gold. The importance is to actually own the gold, whether it's through a fund such as ours, whether it's direct ownership, depends on how wealthy you are, or whether it's a few coins that you bury in the backyard. That's up to you, and it depends on your wealth. But it must be that you actually own the real gold, and you simply don't have a paper IOU or a proxy or a derivative. That's what's critical.
Now, when we discuss the possibility of the $10,000 goal, how do you see the Dow Jones responding to such an increase? Should we be concerned when we think about the possibility of the US dollar continuing to lose its value? Should we be concerned about the Dow Jones in this matter of investing in gold?
Well, there's two components of your question there, is the US dollar losing its value and what an investment in the Dow equities would mean. The US dollar is, unless there's radical changes, is going to continue losing value. And that's simply that the US deficit is in excess of $1 trillion a year now, and they're creating $1 trillion of new debt, of new money, and as you create more and more money without economic growth to match, the currency will lose value. So the US dollar is inflating, away and losing purchasing power each and every day as we stand. And it doesn't look like there'll be any changes to stop that in the near future. The Dow Jones, it's a question of measuring the Dow Jones in real terms. So many people that have studied the relationship of Dow and gold believe the Dow to gold ratio will be 1-to-1 again. And if you look at mapping the Dow gold ratio over the years, you'll find that the Dow gold ratio was 1-to-1 in 1933. It was 1-to-1 again in 1980. And then it peaked up to 44-to-1 in the year 2000. So many people that have studied this at length believe it will again be 1-to-1. The question is, will it be 1-to-1 at $5,000 gold and Dow, which means a deflationary environment, 10,000 Dow, 10,000 gold, 20,000 Dow, 20,000 gold? That's what remains to be seen. But the important thing there is that in an inflationary environment of the Dow going to 20, 30,000, that's not in real terms. It's not in inflation-adjusted terms. And that's what's important. It's important to measure how the Dow is doing in gold ounces always.
Based on our concerns about the Dow Jones, are we looking for the richer to simply get, for the rich rather, to simply get richer here and the poor get poorer? Or is there some central meeting place for all investors, be they small or great? How does this strike a balance for us?
I think it's not going to be a question of rich or poor. It's going to be a question of people that have approached the current conditions with an open mind and educated themselves versus ones that haven't. I believe there'll be a gigantic wealth transfer event, and it doesn't matter whether they're rich or not so rich, but if they get caught in what's coming in terms of a financial crisis, they will lose. The people that hold gold will gain. So these could be poor people, they could be rich people. Right now, very few people in the West own gold. Approximately, the retail investor holds less than 0.5% in gold. Institutional investors hold less than 1% in both gold and gold mining stocks. So it's very much under-owned, and it hasn't yet developed into a full, if you want to call it a bull market. In contrast, in 1980, institutions and retail investors held 20% in gold. Now the issue is that there's $250 trillion in financial assets globally. That doesn't include real estate or derivatives, such as stocks, bonds, treasury bills, etc. And about $4 trillion in above ground gold. Of the $4 trillion above ground gold, half of it approximately is owned by central banks, and the other half is owned privately. Of the privately held gold, the vast majority of it is held by the world's wealthiest families. And they never sell no matter what the price, and the central banks are buying. So the issue in terms of this disparity is that if even 10% of the $250 trillion that are in financial assets, i.e. $25 trillion, tries to buy gold, of which there's only $4 trillion in total, most of which isn't for sale. The only adjusting factor can be the price.
So then you're also seeing gold as the best investment across the entire globe, not only in the U.S. Canadian economy, not only in the amidst the G8, shall we say, but across the globe. Am I right in thinking this?
That's right. But again, we get back to the difference between real money and currency. Right now, we have a situation where all currencies throughout the world are simply fiat currencies, i.e., are currencies made by government decree, and they're not exchangeable or backed by gold. So that has never happened before in history. However, throughout history, we have never had a single example of a fiat paper-based currency that didn't end in hyperinflation followed by complete collapse. Never even one example. In recent years, although we've all heard about Germany and Zimbabwe, but in total there's in excess of 50 hyperinflations throughout the world. So once you've experienced a hyperinflation, as many people in Eastern Europe and Southeast Asia and South America have, they understand the purpose of gold.
Point us to anything that you may have written, whether in $10,000 gold or otherwise, that we ought to be ever mindful of, whether we're investing in gold today, tomorrow, next year, or we're just bearing it in mind. What is it that says to us, above and beyond anything else that you've written, what line is there that says this is definitely the way to go?
Well, we have one of our advertisements that shows a picture of a fire extinguisher with a title saying, in the case of a fire, what would you like? A real fire extinguisher or a picture of one? And with that, we try and hit the point home that if you've got simply a paper financial derivative, proxy IOU for gold, you don't own any gold. And you're totally dependent on the entity that you're dealing with for being good on the delivery and so on. So the most important thing is always to own gold, whether it's a few coins that you hide in the backyard or whether it's hundreds of bullion bars that you store with us under a custody agreement with the Bank of Nova Scotia. But in all cases, it's critical that you actually own the gold and are not simply dealing with a paper proxy or a derivative.
And then I suppose I'm going to ask you the question that any quote-unquote preacher would want to ask. How does investment in gold lead to the one world order, the one currency for the globe? Is this the item that makes this possible or no?
No, and using gold as money avoids the one world order, one currency, because it's something then that can't be created at will and manipulated and so on. It's truly honest money. And from a religious point of view, if you look at any of the religions, then they'll all mention that gold is the only form of honest money. Everything else is simply a debt-based instrument, an IOU. So it's a thing that could prevent a one world order and a one currency, which seems to be, whether it's a conspiracy theory or a real agenda, we don't know. But with gold, that would prevent it.
Do you see anything else comparing in any way, any of the precious metals comparing in any way to the bullion, to the gold, especially in light of your writings in $10,000 gold?
Well, there's precious metals and rare metals, but there's only three metals, gold, silver, and platinum, that have established long histories of being used as money. Silver has even a longer history than gold as being money, and platinum was used as money in Tsarist Russia for over 300 years. right now all the mints of the world, the Canadian Mint, the US Mint, the various mints in Europe, will all mint gold, silver, and platinum coins. So all three of them have certain commodity attributes and have, right now, what I believe is more important is the monetary attributes. And all three have functioned as money and will function as money. In terms of performance, I think that both silver and platinum, for different reasons, will increase in value more than gold itself.
And shall I ask then, if you saw anything else, you would tell us, like you did in your book, suggesting that gold is the inevitable rise, the safe haven for the investor.
Well, as I mentioned, both silver and platinum have all the same attributes as gold, and there's a good argument to be made that they'll outperform gold for different reasons. And I lay those out in the book. There's a separate chapter on silver and platinum. So you can do all three or choose one as you prefer. Gold was just, it's more popular and more easily to deal with as a title.
When we look at small countries like Turks and Caicos, small economies, possibly lots of money is passing through, should we as a country be looking at this specifically, again, due to our size, due to our market constraints, due to the fact that any bigger market will have its effect on Turks and Caicos?
Well, the issue, whether it's big or small, countries hold gold in their reserves because it's the asset of last resort. If the paper currencies get to a point of being unacceptable, and there's many people have hypothesized about the US dollar as well as the other currencies where they'll simply become not acceptable anymore, then in a country like the Turks and Caicos that has to import a lot of products, including food, they need something that they can use for payment. And right now, as you have an example in Egypt, nobody will accept the Egyptian pound as currency, and now you have food shortages, gasoline shortages, and so on. People that live in the country can't get the money out because no one will accept the Egyptian pound, so they're stuck there. And there's an old saying that always goes that, you know, the ultimate reason for having gold is to pay off the border guards to get out of the country, and that's, for example, what people in Egypt now need.
So then, are we suggesting that investors in Turks and Caicos look at this more as an opportunity for growth or as an opportunity for steady reliance as opposed to some other investment as you see it?
To begin with, people should look at gold as the tool to diversify a portfolio. Some people look at it as insurance for a portfolio. And the reason for that is gold and also silver and platinum are the most negatively correlated asset class to traditional financial assets like stocks and bonds. So everybody agrees that they should have a diversified portfolio, but having only stocks, bonds, and cash does not make it a diversified portfolio. You need 6 asset classes, not 3, and the other missing 3 are real estate, commodities, and precious metals. So that starting point is diversification, so that your portfolio has the least amount of fluctuation during any kind of conditions. After that, you look at the current conditions, and you need to do your homework and do your studying, and that's where I'm hoping the book will get people started, to then decide how they should reallocate the portfolio by lightening up on financial assets and increasing their holdings of precious metals in the process.
Compare your gold or your understanding of gold, and especially the $10,000 gold, to, say, silver.
I think silver will outperform gold, and there's a number of reasons for this. Number one is silver is now rarer than gold. And the reason for that is all the gold that's ever been mined in history is mostly still here. It's in vaults and is available. All the silver that has been mined, stolen from the Mayans, whatever, is now gone because it's being used primarily in industrial products, and because the price is relatively cheaper than gold, it hasn't been recycled. So the above ground silver stocks are very low at this point in time. Secondly, the issue of the ratio between gold and silver is 16 to 1 under the U.S. Coinage Act, when both gold and silver were the official money of the U.S. The ratio of gold to silver in the ground is 16 to 1. And in 1980, when gold and silver peaked, they peaked at a 16 to 1 ratio. So it doesn't guarantee that it should be 16 to 1, but even the historic mean is closer to 20 to 1. So the issue is that silver has a long way to go to catch up, because it's now in excess of 50 to 1 under current conditions. So as the gold price rises, it should catch up and get closer to a 20 to 1 ratio at least, if not 16 to 1. The other thing about silver is that there's very few pure silver mines in the world. Most of the silver that is produced by mining companies, 70% in real terms, is byproduct production from other mining operations like lead, zinc, copper, and even gold. So if the price of silver was to go to $200, you have a situation where it's both price and demand inelastic. And what that means is if you have 2 cents of silver in your phone at a price of $20, it's not going to prevent you from buying a phone if that 2 cents goes up 100-fold. Okay? So that's where the supply inelastic, as the price rises, it'll have no effect on all the electronic components. Secondly, as the price rises, because 70% of it are produced, as byproduct, then you simply can't increase production because the price is now $200 an ounce. So the only thing that will adjust is the price, not supply or demand, which is the common case.
And then finally, tell us why you think it's absolutely necessary that we read this book, that we get a copy for ourselves, and that we understand all that you see as it relates to gold and the investor. Gold being the safe haven for the investor.
I think simply that if you take the time to buy the book, educate yourself, verify the information that I've said in the book, and then buy gold, silver, and platinum, it will not only preserve your wealth, but increase your wealth over the years. So it's a very small investment, given the consequences of not knowing what the outcome for the economy and for investments in gold, silver, and platinum will be. And that's what I tried to address in the book.
We want to thank you, Nick, for the opportunity to share with us, and we do hope that we've given you as wide a range of an opportunity to talk about not only your book, but to talk about investment in gold. Now, certainly, all of our On Your Mind show ends with the guest of the show having 2 minutes to speak to the audience, and I'm going to give you those 2 minutes just now to speak to the audience and say anything else that you might not have told us as to why such is important.
Well, thank you, Reverend Conrad. It was my pleasure to be on your show. If people want more information, they can go to our website, bmgbullion.com. We have a number of reports, webinars, a list of books that people can read. I do a weekly newsletter. All this is available for your audience and your readers in the hope that they'll get a better understanding of gold. The book is available through Amazon.com, so it's easy to order, and it's available both in hard copy and in Kindle version. So again, my pleasure to be on your show, and good luck to your listeners.
Ladies and gentlemen, we want to thank Mr. Barashef, Nick Barashef, for not only writing his book, but also taking the time to share about his book and investments and the safety of such investments in gold on Your Mind, the show where your opinion counts. And so we look forward to continue sharing with you on Your Mind, not only this evening, but in the days to come. I'm your host, Reverend Conrad Howell, saying so long, and may God bless you richly.